In trading, the required margin refers to the amount of capital a trader must deposit to open and maintain a leveraged position. Margin serves as collateral to cover potential losses and is crucial for enabling traders to take on larger positions with less capital. This amplification of buying power is a key feature of leveraged trading in Forex, stocks, commodities, and other CFDs, but it also increases risk. Understanding margin is usually expressed as a percentage of the trade's total value. For instance, a 2% margin requirement on a $50,000 trade means the trader must deposit $1,000. The required margin ensures that traders have some capital at risk, providing a buffer against losses. Brokers use margin as a security measure, ensuring traders have enough funds to cover adverse price movements. Types of margin. Initial margin. This is the margin required to open a position. For example, if a trader wants to trade a $100,000 Forex position with a 1% margin requirement, they need $1,000 in their account. Maintenance margin. This is the minimum amount required to keep a position open. If the trader's account balance drops below this level due to losses, they may face a margin call, requiring additional funds to maintain the position. Free margin. Free margin refers to the equity in the account not tied up in margin. It is available for opening new trades or cushioning against losses. Margin requirements. Across markets. Forex typically offers high leverage, sometimes up to 1 to 500, resulting in low margin requirements. For instance, a $10,000 position with a 1% margin requirement would need only $100. CFDs. CFDs on stocks often have higher margin requirements, e.g., 10 to 20%, due to higher volatility. Indices and commodities may have lower requirements, depending on the broker and asset. Factors influencing margin leverage. Higher leverage reduces the margin required, but increases the trader's risk. Market volatility. Assets with high price swings often require higher margins to protect against rapid losses. Broker policies. Brokers set margin requirements based on regulations and their risk appetite. Importance of margin management. Effective margin management is essential for risk control. Over-leveraging can lead to rapid losses, margin calls, and forced liquidations. Traders should maintain sufficient margin in their accounts to absorb market fluctuations and avoid unnecessary risks. By understanding required margin and using leverage wisely, traders can optimize their positions while managing potential losses responsibly.